Rakesh Jhunjhunwala, one of India's most successful stock investors, passed away on 14th August at 62. In this video, I analyze how he grew his wealth to almost $6 billion from just $60 and how we can replicate his success. Financial big shots die all the time without causing any waves. But the oldest and the biggest stock exchange in a country of 1.3 billion, the Bombay Stock Exchange, does not transform its trading floor into a prayer hall for everyone. But it did for Rakesh Jhunjhunwala on 16th August. For hours, thousands of his admirers mourned his passing away in the once noisy room. Music played softly while a large screen showed snippets of advice Mr. Jhunjhunwala used to colorfully dispense on TV. When he passed away, he received praise from India's political and business giants, including Indian Prime Minister Narendra Modi. He was a folk hero and a role model who showed middle-class Indians that stocks are a viable, high-return alternative to investing in fixed deposits and gold. I remember this very well growing up. I don't think my dad ever invested in stocks until very recently, and only because he got employee stock options. Indians primarily deposit their savings in the bank and buy gold or real estate. But thanks to people like Rakesh, stocks are an increasingly popular destination for savings, as they should be because they offer the best returns of all the asset classes in the long term. Mr. Jhunjhunwala was known as India's Warren Buffett. He began investing with just 5,000 rupees or $60 in 1965 at the age of 25. By his death, 37 years later, his net worth was just shy of $6 billion. That's an annual return of over 64%, more than 3 times Warren Buffett's annual return of 21%. When Rakesh told his father that he wanted to build his career in stock market, his father advised him to do it only if he enjoyed it and not for money. Advice he never forgot. Though he earned great riches and fame, it was not money that motivated him. It was the thrill of being proved right. Warren Buffett, it so happens, has the exact same advice. So the first thing you can do to replicate Rakesh Jhunjhunwala's success is to choose your line of work for the right reasons. Pursue a job or a career you actually enjoy, in a workplace with talented people you really admire. Like Buffett says, seek employment in the field you would select if you had no need for money.
Look for the job that you would take if you didn't need a job. I mean, don't sleepwalk through life, and don't say it's all going to be great. I'll do this and I'll do that, and I'm just marking time till I get to be older. That, as I've told people, that's like saving up sex for your old age. I mean, it just is not it is not a good idea. Yeah.
I think a significant part of his success is because of the way he analyzes companies. He does not just look at financial statements, break them down into their component parts, and analyze them in statistical depth.
The most interesting aspect of investing is the kind of mental and intelligence you have to use, mental power, and it requires the use of all senses, just as the Kamatra Sutra says. That you don't only have to look at material matters, about figures. You got to judge character of people, right? You got to judge the quality of entrepreneurs. So investing is such an encompassing and interesting profession, and the greatest thing about it is the uncertainty.
But isn't that like a really big description? I mean, does it take all that to decide on what to invest in?
Absolutely, ma'am.
He actually tries to get a feel for the big picture of the business. For example, how are the employees interacting with each other? What is the overall spirit of the various teams? And what is the overall tone and the unstated message being sent down by the man or the woman at the top? Most investors ignore these and many other intangible things because they either look at the outside or the inside of the company, but not both. This poor quality video gives an insight into his analysis of one of his most successful investments.
But what made you think that Titan was the pretty girl?
Because Ramesh, my basic call in my investing is on India's macro. And I thought India is going to have a huge consumer market. And I think that Titan itself is surprised by the kind of opportunity they are seeing. Right? And I thought Titan is well entrenched. Nobody could come into watch business. They are a very good marketing company. I thought branding business in jewelry will eventually succeed. And Ramesh, remember one thing, my investment strategy is an entry value, a constant review, and a perceived exit value.
In his excellent book Laws of Nature, Robert Greene explains this in terms of masculine and feminine thinking styles. Masculine thinking tends to contrast between things, to better label them. It wants to take things apart like a machine and analyze separate parts that go into the whole. Its thought process is linear, figuring out the sequence of steps that goes into an event. It prefers to look at things from the outside with emotional detachment. The masculine way of thinking tends to prefer specialization, to dig deeper into something specific. It feels a pleasure to uncover the order in phenomena. But feminine thinking focuses on the whole, how the parts connect, and the overall big picture. In looking at a group of people, it wants to see how they relate to one another. Instead of freezing phenomena in time to examine them, it focuses on the organic processes, how one thing grows into another. In trying to solve a puzzle, the feminine style will prefer to meditate on several aspects, absorb the patterns, and let answers or solutions come to the individual over time, as if they needed to be cooked. This form of thinking leads to insights when hidden connections between things suddenly become visible in intuitive flashes. As opposed to specialization, it is more interested in how different fields or forms of knowledge can connect to one another. So the second big takeaway from Rakesh Jhunjhunwala is to think holistically. Mix masculine and feminine thinking styles to get a more accurate grasp of reality. History is full of powerful examples how different mixing styles paid off. For example, Einstein attributed all his great discoveries to intuitions. Long hours of thinking gave way to sudden insights about the interconnection of specific facts. Rakesh Jhunjhunwala's rise mirrored India's. He benefited from the economic liberalization of the 1990s and the patience to hold on to his investments for decades, earning him vast returns. Some of his best performing stocks include Apollo Hospitals, which increased by more than 100 times during the 17 years he held on to it between 1998 and 2015. Bata Shoes was another 100x multi-bagger, as home run investments are popularly known as in India. He held on to it for 23 years. But the investment that made him the most money was Titan, a watch and jewelry maker part of the Tata Group. In fact, Titan makes up about 30% of his total net worth. He invested based on his instinct and then did his research. He would do his own research and thoroughly analyze the stocks he invested. And like any other investor, he was an avid consumer of information. He always had 5 price screens on his desk and multiple phones. He often made sober strategy presentations to many companies he was a board member of. But he admits mistakes and says he often invests based on instinct first, then analyzes later. His fundamental insight may have been to be bullish on India a decade ago and to have favored good quality. Optimism about India seems to come naturally to him. He appeared regularly as a stock market pundit on television interviews and would roar at his fellow panelists for being too cynical about India.
How do you explain it?
One of his famous lines while talking about why he's bullish on India was, "Growth comes from chaos, not order." He was also an avid lover of Indian movies and its music. He even invested in 3 Hindi language movies. So the third biggest takeaway from Rakesh Jhunjhunwala is also his biggest bet on India itself. He bought in when the country was in doldrums before the 1991 liberalization and held on. When other successful investors moved themselves and their money to Singapore or London, he stayed in India. So to replicate his success, invest a significant portion of your savings in India. I wouldn't recommend picking individual stocks unless you're willing to make it your full-time job. But I would recommend investing in a broadly diversified stock index fund. In a world where population growth rates are reducing and globalization is unraveling, very few economies are growing at 7% or more. India is one of the few large economies expected to grow at 5% or even higher. In the days before his death, Rakesh repeated the advice he often gave with added urgency. India's golden decade, he insisted, was just beginning. At the last stage of his life, Rakesh gave the most valuable and profitable investment advice ever. He said his worst investment has been his health and encourages everyone to invest the most in it. He was worth billions of dollars. He often said he had the best job in the world and felt lucky to have the kind of friends and family he had. He clearly had everything one can wish for in life except good. He was not born with lousy health. His lifestyle made it so. His office actually had a gym, but Mr. Jhunjhunwala, a big riot of a man, never used. Instead, he consumed 6 pegs of whiskey, 25 cigarettes daily, and ate like a pig, in his own words. He died of a sudden cardiac arrest. He was also suffering from chronic kidney disease and was on dialysis. In addition, he had diabetes and had recently undergone an angioplasty. Like Warren Buffett, Rakesh Jhunjhunwala made most of his wealth after crossing 55 years of age. His life got cut short unexpectedly. But had he lived and invested for as long as Warren Buffett did, with his track record of generating 64% per year, who knows how many hundreds of billions of dollars he would have made, or even trillions of dollars. So the final takeaway is his advice to invest the most in his health, something he regretted not having done at the very end of his life. And this advice is worth billions of dollars. The best part is that it requires investing your time, not your money. If you like this video, I recommend that you watch this one, where I analyze 3 personal finance lessons you can learn from Olympic level endurance athletes. I'm Sharat Mantrawadi. Thanks for watching.